Hey guys, in this video we're going to talk about ICT's optimal trading zone and optimal trade entry. This theory mostly relies on Fibonacci retracement levels and foundational price swings to spot the beginning of upcoming impulsive movements and define possible targets. We have simplified this trading model into 3 easy steps: the analysis phase, trade execution, and management. We will explain how you can combine this concept with market structure, fair value gaps, and higher time frame key levels to enter a high-quality trade. So guys, if that's something you're interested in, as always, make sure to hit the like button to show your support and subscribe to our channel if you're new. See you after the intro and disclaimer. When opening the charts, the first thing we will look at is defining the price swings and key structure levels. In other words, performing a top-down analysis from higher time frames to lower ones allows us to get a comprehensive view of market conditions at all levels. When talking about higher time frame key levels, we refer to the weekly, daily, and 4-hour charts. Anything less than 4 hours is too short-term for large institutions to effectively refine their plans. When we notice that the price has dropped from a higher timeframe resistance level, we can reasonably assume that many institutions were interested in selling at that point. Conversely, if the price rises from a support level, it suggests that institutions were likely interested in buying there. This way, we're not concerned with small intraday fluctuations. Instead, we focus on significant movements that indicate major players are influencing the market. These larger trends are visible on higher timeframes, which we've repeatedly emphasized as crucial for analysis. Therefore, identifying higher time frame swings and key levels will help us get a clearer view of the bigger picture, avoiding getting caught on the wrong side of the market. Then, we can zoom into lower time frames like the 1-hour and 30-minute charts to spot potential trading opportunities. If you look at the chart, you'll notice that the market always moves in impulsive and corrective waves. This fractal nature of the market occurs due to the behavior of market participants. Impulsive waves often push the price a greater distance with momentum, characterized by same-colored candles with large bodies. In contrast, corrections represent indecision on the chart, marked by mixed-color candles with small bodies and sideways wicks. Identifying the end of a pullback and the start of the upcoming impulsive move can be highly profitable, as it enables traders to capitalize on potential buying or selling opportunities in the market. Imagine we are in an uptrend and want to buy low and sell high to benefit from this bull market. We cannot open a buy position right now because the price is too high and may drop at any moment. So, we need to wait for a correction to enter at a better price. The latest impulsive move started from here and pushed higher all the way up to here. The correction will happen inside this range, and when the market gathers enough liquidity and buyers come into play, it will continue pushing higher again. If the price breaks below this level, it shows that the buyers are no longer in control, and the whole idea of an uptrend comes into question. It indicates significant bearish momentum and signals a possible reversal, unless it was a fake-out, where the market aimed to gather liquidity below this low before taking off. Now back to our correction range. Here's the question: where should we place our long position and enter the market? If we enter too early, the price might make a deeper pullback, and we end up losing even though our analysis was correct. On the other hand, if we wait too long, the price might start pushing higher without us entering, and we miss the trade. So, the key to trading with the dominant trend is to identify the end of the correction, which marks the start of the next impulsive movement. But how do we do that? This is where Fibonacci retracement levels come into play. We always apply this tool from the start of the impulsive wave to the end because it helps us identify the correction range. If you apply this tool, you'll notice that several levels appear on the side. All of these important levels can act as support and may reject the price when it reaches them. However, there are 2 specific retracement levels that create ICT's optimal trading zone, OTE. The 61.8% and the 78.6% levels. There are multiple reasons why this range is considered an optimal area for trading. Reason number 1: higher risk-to-reward ratio. We know that no matter where our entry is, the first target for the trade is this recent level of market structure. When the price taps into this level, some traders will close their positions or take some profits, while others might go long. This can create a correction or even reverse the direction. So this level is going to be our first target. If you enter in the OTZ, your risk-to-reward ratio would be reasonable. We always aim for our trades to have at least a 1-to-2 risk-to-reward ratio. That's why trading inside the optimal trading zone will give us a higher risk-to-reward ratio and a more rational trade. Reason number 2, safer entry. The market loves to take out early buyers and use them as liquidity for future movements. So, waiting for the price to enter the optimal trading zone and then looking for signals to go long will instantly increase our win rate. Of course, every strategy has its downsides. In this case, we might miss some trades due to conservative trading, but a missed trade is always better than a losing one. Reason number 3, safer stop. The best price level to set our stop loss, to be safe from market fluctuations, is below this swing low. Because if the price breaks through this level, we will have a market structure shift. So, the bulls will do their best to support this level. Therefore, the closer your stop is to this level, the safer it is. This is the third reason why we enter trades in the OTZ. With all that being said, finding an entry reason within this range is a great way to enter a high-probability trade. This entry reason can be various price action signals, which we will cover later in this video. Now that we have defined the optimal trading zone, let me explain ICT's optimal trade entry model. This trading model consists of 3 simple steps: analysis, execution, and trade management. Let's start with the analysis phase. As I mentioned earlier, this trading strategy is a trend continuation setup where we want to anticipate the end of the pullback or correction and go long with the dominant trend. In the first step, we want to identify the market direction and the latest impulsive wave. We only use this setup when we can clearly identify the direction. The most recent impulsive movement must break the recent structure to be considered a valid movement. Now, there's only one thing left. We must ensure there is enough room for the price to move before tapping into a higher time frame key level. If the price has already mitigated a key supply area on the higher time frame, we won't enter a buy trade without confirmation, because this higher time frame key level has enough power to reverse the dominant uptrend. So, generally in the analysis step, we identify the market direction, the latest impulsive wave, and how much room we have before tapping into a higher time frame key level. The next step is executing the trade. In this step, we wait for the price to make a pullback and apply the Fibonacci retracement tool from the start of the impulsive wave to the end. Then, we place a buy limit precisely in the middle of the 61.8% and 78.6% levels, which is the 70.5% retracement level. Our stop loss will be set a couple of pips below the swing low. The last step is managing the trade and defining the targets. We know that if the price taps into this area, it will most likely act as resistance and reject the price lower. So our first target would be just before reaching this level, which could be the close of the highest candle. For the second and third targets, we will aim for the -27% and -61.8% retracement levels. Let's have a recap in the bearish scenario. But before we continue, if you're curious about how we stay updated on financial news and fundamental analysis, well, we rely on Fastbull, one of the best trading websites with various useful trading tools. This site provides one of the most accurate and detailed economic calendar, a tool we use every day before starting our technical analysis. 24/7 economic live streaming also allows us to stay informed about the latest trading world's news and fundamental analysis. So if you want to benefit from multiple trading tools, like copy trading, financial news, and unlimited access to the price charts that can significantly improve your trading, make sure to check the link in the description. The same concept applies to a bearish scenario. In the first step, we identify the downtrend, the latest bearish impulsive movement, and how much room we have before reaching the next important area. We want to go short with the dominant side of the market and benefit from the bearish momentum. That's why we need to identify the pullback range. The latest impulsive wave started from here and went all the way down to here, so this is the range where we expect the pullback or correction to occur. Now, in the next step, let's apply the retracement levels and define our entry. Here, we will set a sell limit precisely at the 70.5% retracement level and place our stop a couple of pips above the swing high. For the first target, we will aim for the close of these candles, because this level will act as support when the price taps into it again. For the second and third targets, we will aim for the minus 27% and minus 61.8% retracement levels. This is ICT's optimal trade entry model. As you can see, this model is based solely on basic price swings and retracement levels. Now, some of you might think that trading can't be this simple and still be profitable. However, simplicity is key in Forex trading. Your trading plan must be straightforward with mechanical rules, where you can clearly define where your entry, stop, and targets are positioned. This way, you can confidently trade based on your backtesting results, knowing that your emotions are not incorporated into your trading decisions and that your backtesting results closely mirror real trading scenarios. Now, this was the basic model. We have developed it further by combining it with multiple smart money signals, including fair value gaps, market structure shifts, and multi-time frame entries, which we will discuss now. Combining optimal trade entry with fair value gaps. Here, we have a clear uptrend. We want to wait for a pullback to enter a long position at a better price. If the price breaks below this level, the whole idea of the uptrend comes into question, as it signals significant bearish momentum. So, here's the correction range, and we can identify the optimal trading zone by applying the retracement tool. Now, if we look at the left-hand side, we can see that the latest impulsive movement has created multiple fair value gap areas, one of which coincides with the optimal trading zone. When the price pulls back to these areas, they will act as support and likely push the price higher. However, a more conservative approach is to wait for the price to retrace all the way down to the third fair value gap and enter the long position there. This is because there is a higher chance that the price might use the first fair value gap as a liquidity grab and trap traders who went long there. In summary, the combination of the optimal trading zone and fair value gap areas provides solid supply and demand zones and presents a high-quality trade. Combining optimal trade entry with market structure shift. Here, we had a long-term downtrend until the price first failed to create a new lower low, indicating a loss of momentum. Then, it broke the supply level to the upside. This change of character shows that the sellers are no longer in control and suggests a potential reversal to the upside. Once we see a break of structure above the previous high, it indicates that the buyers are now completely in control, marking a complete market structure shift from a downtrend to an uptrend. Now is the time to look for long opportunities to benefit from the bull market. Here's the question: when do we enter the long position? Even though the price has a high chance of continuing upwards, we could still get stopped out if we enter at a poor price. This is when we apply the concept of price swings and ICT's optimal trade entry. Our directional bias is bullish, and we have enough space before reaching the next important level, which is above here. We can apply the retracement tool to the latest impulsive movement and set a buy limit at the 70.5% retracement level. Our stop loss will be placed a couple of pips below the swing low, and we will set the targets according to the trading plan. This is how we combine the optimal trade entry with the market structure shift concepts to enter a high-quality trade. However, it's important to remember that no matter how good the trading opportunity seems, the market can have different plans. Risking an unusual amount on a single trade just because you think the chances of winning are high is a bad decision. Trading is about predicting future movements, and the future is inherently unpredictable. For a 50% loss, you would need to gain 100% of the remaining capital to break even. Survival is more important than gains in the Forex game. Number 3. 2 time frame entry. In this trading setup, we use 2 time frames to enter the trade. We perform most of our analysis on a higher time frame, such as 1 hour, and then zoom into a lower time frame, like 15 minutes or 5 minutes, to find confirmation and enter the position. Let me show you how. On the 30-minute chart, we have a clear uptrend. We apply the retracement tool and mark the optimal trading zone. As mentioned earlier, When the price pulls back to the optimal trading zone, we then zoom into a lower time frame to find an entry reason and buy the pair. However, on the lower time frame, this move may appear as a downtrend. So our goal is to find signals that indicate the downtrend is over, and that we can enter a long position in alignment with the dominant bullish higher time frame direction. When we witness a change of character, we can consider entering a long position. In this trade, we know that the higher time frame trend is bullish, and we are in the optimal demand area. Thus, we have combined multiple price action concepts and signals to enter this trade. Combining optimal trade entry with price action techniques, such as fair value gaps, liquidity, chart patterns, candlestick patterns, or any other entry reasons you use, can provide a solid trading strategy. So guys, I hope this video has been useful to you. If it has, please click the like and subscribe buttons to help us continue producing more content like this. I wish you great success in your future trades. See you in the next episode.